And for those of you that did see, last week we did a little bit of a mini series on debit and credit spreads. Alfonzo had a question that he had brought in, part one, finding positions that meet a specific return requirement. And he had mentioned that on his credit spreads, he looks for a net credit that's a third of the difference in strike prices. So if we're using a 5-point spread, he's looking for a net credit, of about $2.25, $2.15, $2, something like that. That 60% rule. If he's got a dollar spread, he's looking for a 33-cent net credit. Well, since the credit is achieved up front, even if I have a $1 spread and I collect 33 cents of net credit, that's really about a 50% return, isn't it? Because I keep the credit regardless. So the max I can lose on the position, even if I have to close the position for that $1 difference in strike prices if the spread moved against me, the max loss I can have is 67. So I'm making 33 to risk 67. I'm really at about a 50% return. So we created a search to look for those types of positions, and we found 3 positions that matched close to our default criteria, but changing it to a 2-week out spread, looking for a high return, close to 40 to 50% return against the risk for bull call debit spreads, which meant we had to lower the probability down to 70, 65% or so. So that was there. Then we talked about criteria for the higher return positions and looking for the at the money versus out of the money debit spread, and then the importance of controlling risk using the trade simulator tool. Now I'm bringing that up because we want to take a look here. Let's navigate over to PowerOptions now. And in that webinar, when we found the 3 positions that matched Alfonso's preferred criteria, I had mentioned that we wanted to put those into the portfolio tool to start tracking them. Side note here, I just wanted to mention that a new thing has popped up recently. With our new email provider, we've noticed a lot of emails haven't been able to reach you. Not too much. You're still getting emails from us. Obviously, some of you are still here in attendance during our presentation, so you're getting our emails about the webinar invite. But if you see this message here, it's just letting you know that we can't deliver to your email at this time. Please give us a call, and we'll get that squared away as best as we can. Just something bounced, something glitched one day or another. It went to spam more than 3 times, whatever restrictions or requirements they have. So if you see that as a subscriber, you want to get emails for us, see this new message, give us a call, and we'll take care of it as well. Now, we haven't updated the market sentiment tool. We're still at sell warnings. That's going to be something important in a moment we're going to take a look at. But now, let's jump into the portfolio. And let's look at the 3 bull call debit spreads that we found for Alfonzo last week based on his requirements, where he normally looks again for 1/3 of the net credit in a credit spread against the strike difference, which we assumed would be a 50% return based on what I just said a moment ago. So in the portfolio, we went ahead and there's the bull put credits. We're going to get to those in a moment. But the bull call debits, the 3 bull call debits that matched Alfonso's criteria when we ran the search, was on Robinhood. And at the time, Robinhood was trading at around $23 or so. And we could sell the in-the-money 2050 call, 2050 strike. Midpoint was 211, and buy the 20 call at a midpoint at 237. So we're going to get a 26-cent net credit against a risk of $24 essentially on a 50-cent spread. So we're looking at expected 92.3% return. Now, right now, the bid-ask spreads are really out of whack, it looks like, at the close of business. So it's telling us that we could make 182.7%. But really, right now, if we liquidated this position, we'd be close to 90% of what we expected on this particular trade. Let's take a look here. Let's just go to the profit and loss chart. So again, when the stock was trading around 23, let's just change that here to this expiration. There we go. When the stock was trading at around 23 the other day, a little bit higher, could have entered this position selling, the 2050 strike, the upper end of the bull call debit for 211, and paying 237 for the 20 strike. 26-cent net debit in a 50-point spread. So the max profit is 24 or 92.3%. Now this was from last week, so it was a 14-day trade. We have 7 days remaining to expiration. As I mentioned, it's probably possible right now still with the stock trading at 22.42 and with 7 days, half the time value decayed out of it, to close this for a reasonable profit of about 85 to 90% of the max we expected. We would probably get 22, maybe 21 cents profit on this position. So that's looking pretty good on the Robinhood position for now. NCLH, though, Norwegian Cruise Lines. The stock was trading roughly at about 18.20, I think it closed on last Friday, but it's dropped now to 16.56. The spread we found was selling the 17 call, buying the 16.50 with a net debit of 34 cents. So it was about a 50% profit. We could make probably 16 cents. So what would happen? We'd close the bull call debit spread for 50 cents if it was in the money at expiration. There we go. Let's expand our chart a little bit here. So we'd sold again the 17 strike call and bought the 16.50. If the stock remains above 17, well, essentially if we held it through expiration, what would happen? Our broker would assign us, we'd have to deliver shares of stock at 17, but we have the right to buy them at 16.50. Our debit was 34. We'd get 50 cents back. It's not include commissions at this time. So we'd make 16 cents, $16 off a debit of 34 for a 47% return. But NCLH has dropped now to 16.56. So the liquidation value, if we close the position, we'd only get 22 cents back. We'd have a loss of 12 cents or 35%. And if we hold it to expiration and the stock remains the same price, we'd lose 82.4%. And last week, that part 3, we discussed the importance of not allowing a spread to go beyond a 50% loss on the position. We're not there yet in this trade, but it's getting close. And we can't allow it to go to 60 to 70%. We'll review why in just a few moments. Third position was on. Let's just go to the profit and loss chart. It's probably easier to show it that way. ON was trading at around 41.80, pretty close to where it is now. It moved up this week, then it pulled back down. The 40.50 strike, we would have sold the 40.50 call for around 242 and bought the 40 strike for 276. Net debit of 34 cents, again, on a 50-cent spread. It was interesting to me that all the spreads we found that matched Alfonzo's goals with almost that quote-unquote near 50% return were all 50-cent spread differences. But again, stock stays above 40.50 in the next 7 days. We have the right to buy shares of stock at 40 to cover our obligation of the sold call at 40.50. If we held it through expiration, went through exercise and assignment, we get 50 cents back. Again, 16 cents, $16 profit, just using one contract to keep it simple, off a 34-cent debit, a 47.1% return. And as we saw back on the portfolio, we're at a profit of about $9, so a little bit more than half of the 16 that we expected, 26.5% return. So all in all, just using one contract of these 3 trades, start off with $1,000. Total debit we spent was small, of course. It was only about 94 cents. And if we liquidated everything right now, with the loss that if we liquidated everything right now, we'd have a return of about 4.5%. Because we'd take the loss of 12, make a profit of 4. Now that's inaccurate. So we'd make a profit of 24 and a profit of 9. Why am I still saying it's inaccurate? Because we're not going to get, the bid-ask spreads are pretty wide on these options here for Robinhood. We're not going to make more than we expected. If we close this, the broker would even push us closer to 22 or 23 cents. We're not making a 48-cent profit above the maximum 24 cents we expected to make. That's not going to happen. So it's going to be, let's call it 24. Let's call it max profit right now in Robinhood. We could close it a week early for 24 cents. We probably would if we could get that. Absolutely. 33 cents here, the 24 plus the 9. And then we're losing $12 there. So we'd be at a profit of about half of this here. right? 33 minus the 12 would be a 21. So instead of total market value of 1045 at 4.5% return, we'd be at a 2.1% return would be my guess at 1021. All right. Of course, maybe we could get filled at these prices. I highly doubt it, but maybe we could get filled at those prices to get more than expected. But that never happened. That's never happened in my experience on a bull call debit, long strangle, or long straddle position. Bid-ask spread shows you, hey, if you get midpoint, you're making 82% more than the maximum you expected to get. Yeah, that doesn't happen in real life. So just a midpoint pricing. Now, going through that whole exercise, we also talked about the difference here. Alfonso's positions were looking for closer, as we saw, to those 47. This one was a 92% return. This one was a 47% max return. This one was a 47. That 1/3 credit or 2/3 debit against the strike difference gives us that 50% return or near it. But they had lower probabilities. And we're still making 2.1% if we closed everything after 7 days. But then we talked about our preferred bull put credit spread screen, the weekly bull put credit spread that's looking for 2-week out trades, but a higher probability of 85% and looking for a lower return range. And most of these, we're going to see some that are 24 close, half of what Alfonso was looking for, 17, 15, 16, and so forth. But last week, on the close of Friday, the positions we looked at for Alfonso's 3 bull call debit spreads were based on the close number of values. That's what we added. But on the close also last week, the 3 bull puts that likely were the top 3 of the search, we had Dick's Sporting Goods. Now, this is a reverse one. Instead of using in-the-money calls in a bull call debit, we're using out-of-the-money puts in the bull put credit spread screen. We had DKS, which was trading at about 218, I think, at the time, 219 maybe, last Friday. But the 207.50 put for about 110, and the 205 put for 75 cents, which gave us a net credit of 35 cents. 16.3% return on the position. So the profit and loss chart looks similar, but we have a more shallow grain range here because we were looking for that higher probability was somewhere along the lines of a 15, 16, 17% return. And that's what we saw here. We got a net credit of 35 cents off a risk of 215. Yeah, it's about a 7-to-1 risk-reward ratio. Alfonso's positions were closer to a 1-to-1 or 1.5-to-1 risk-reward ratio. But we have the higher probability of 85%, 207.5 put out of the money. The stock's still trading at 216, even with a $3 drop today. And as we saw in the portfolio, only 57% of the expected profit so far. So I'm not going to close this one. I'm going to hold it longer. First Solar was the other one. Now, it had a big drop today. But when we would have opened this position last week, I think it was around 260. It ran up to 280 this week and then pulled back down today by about 18 points. So it's been bouncing around significantly. But the trade was never in threat. The alerts never got triggered. 1% in the money, stock trading within 1% of our short put strike price, I believe. And we never hit a 50% loss. But even though the stock took a dive today of 17.95, 18 points, and is trading at 273.61, we could close the position at max expected profit was the 40-cent net credit. We could close it now for $4, making 90% of what we expected to make on the trade itself. So I would probably have taken this off the table today, seeing a 90% profit with still 7 days remaining to expiration. But, if we hold it to next week, First Solar stays above 242.50. It's a 40-cent net credit. We'll keep the maximum profit. Again, to keep it simple, profit and loss chart of the position. And we sold that 242.50 and bought the 240. Net credit of 40 cents against a true risk of 210. So once again, we're about just under a 6-to-1, about a 5.2-to-1 risk-reward ratio here, risking 210 to make 40, 19% return. But this had, let me check my notes, folks, I apologize, an 86.3% theoretical probability the stock would be trading above 242.50 at expiration. And we're at about a 90% profit. Meta, interestingly enough, the position was open about, I think, when the stock was at 490 or 480 last week. Does that sound correct? So let's take a look here. I don't remember where it was last Friday. Let's look at big charts real quick. There we go. And so on June 7th, yeah, it was about 492, 491. Okay, so we were at 492, 491 last week on June 7th. The position that came up on our preferred search was selling the 465 put for next week's expiration at about, oh, that's not the right prices. I'm sorry. 1 second. This was supposed to be a net credit of 30 cents. I apologize. I think I just grabbed the naturals. Let's edit that position. So I'm in the portfolio here. Go to position actions. Want to go to edit position. My apologies. This would have been a 30-cent net credit. So let's put this at 75, shall we? And this was on the 7th. 45 for the buy, 46,250. Let's get that correct. There we go. All right. So now the max profit, that looks better, would have been 13.6%. And the liquidation value is 5, so we'd make about 25, 26 cents. We're about an 85% profit on this position as well. The bid-ask spreads don't look too wide. If I liquidated all 3 positions here, we'd have an 8.1% return compared to the 2.1% return that we saw with those higher potential return, lower probability bull call debit spreads that we ran for Alfonzo last week. Well, that doesn't really matter though, right? What matters is the fact that what happens in the next 7 days. But again, 2 of our 3 positions that we opened from the bull put credit spread search, 2 weeks out in time, our preferred search, we likely would have closed already as we're at the 85 to 90% expected profit, assuming we could get midpoint. Would have put that in as a limit order. Would have closed them out if I could get 85% a week early. 85%, I should say, of what I expected to make. 25, 26 cents of the expected 30. 35, 36 cents of the expected 40 maximum profit. Why not take that profit early, a week early on those positions? That's what we kind of look to do, the 80-20 rule. When I get 81, 82% or higher of the expected profit on a credit spread, I will likely close early. But on the credit spreads, remember, the preferred credit spreads with a higher probability that I like to use personally, we're dealing with nickels and dimes here, aren't we? 35-cent net credit, 40-cent net credit, 30-cent net credit, 2.5-point spreads mostly. Look, I'm fighting for every penny. Even if this is 10 contracts, if this is 20 contracts, I'm fighting for every penny I can get. So a lot of times I hold these closer to expiration to try to get as much of that max expected profit as possible. But I probably would have definitely closed these 2 early. And watching this one right now like a hawk, it's not bad. You know, it's 9 points out of the money, so it's about 5% still out of the money on a $200 stock. Stock's trading at 216. We're at 207.50 for our short put strike, the pivot, as I like to call it, of where I focus my potential for when to trigger to alert to close the trade, adjust the trade within 1% of our 207.50.